Hello accounting analyst viewers and subscribers, and welcome to today's video. In this video, I'll be taking a more in-depth look at retirement accounts. This is a follow-up to the previous video where I introduced retirement accounts. So let's get into it. Saving for retirement is one of the most important aspects of your financial life. With fewer and fewer companies offering traditional pension plans and Social Security at risk of going bankrupt, the responsibility for ensuring a comfortable retirement has shifted largely to individuals, to yourselves. Therefore, understanding the various types of retirement accounts available is essential for making informed decisions about your financial future. This video is a follow-up to the previous one where I introduced the basics around saving for retirement. Today, I will provide a more in-depth look at the different types of retirement accounts, their features, advantages, and certain considerations. Hopefully, this will help you to understand better the types of retirement accounts available and to choose the right retirement savings vehicles for your unique situation. As always, this is not investment advice, and this video is for educational purposes only. It is always best to consult a financial advisor before making any investment decisions. I'll start by looking at employer-sponsored retirement plans. These types of plans usually fall into two categories: defined contribution plans and defined benefit plans. A defined contribution plan is a type of retirement plan where the employee and/or the employer contribute a specific amount or percentage of earnings to the employee's individual account. The eventual retirement benefit is based on the total contributions and the investment performance of those contributions over time. Defined contribution plans include 401k plans and 403b plans. A defined benefit plan is an employer-sponsored retirement plan that provides a predetermined guaranteed benefit to employees upon retirement. Think of a traditional pension plan. That's a defined benefit plan. The benefit amount is typically based on a formula that considers factors such as the employee's salary history, often an average of the highest earning years, years of service with the employer, and age at retirement. Now, defined contribution plans have largely replaced defined benefit plans in the private sector due to their lower cost and less risk for employers. Defined contribution plans give employees more control over their retirement savings, but they also place greater responsibility on the individual to ensure adequate savings for retirement. So the distinction here is the defined contribution plans. We're talking about things like 401k plans, as opposed to the defined benefit plans, which are things like your original pension plans. Now, over the last few decades, 401k plans and other type of defined contribution plans have replaced the traditional type of pension plans. So that's where the retirement market has gone to now, and this places more risk on individuals to ensure that they have adequate savings for retirement, as opposed to in the past where the company was on the hook to pay the pension plan. So that's a paradigm shift in employees saving for retirement and places more burden or more risk on the employee to ensure they take care of their own retirement. I will now take a more in-depth look at the different types of retirement vehicles. We'll start with the 401k plans. Definition and basic features. A 401k is a tax-advantaged retirement savings plan sponsored by an employer. It allows employees to save and invest a portion of their paycheck before taxes are taken out. And you have traditional and Roth 401k plans. For the traditional 401k plan, contributions are made with pre-tax dollars, reducing taxable income. This means that contributions are made before the employee's salary is taxed. Withdrawals in retirement are taxed as ordinary income. The Roth 401k is different. Contributions are made with after-tax dollars, and therefore they have no immediate tax benefits. However, withdrawals in retirement are tax-free. And the contribution limits for 2024, employees can contribute up to $23,000 annually to their 401k plans. If you're 50 and older, you can make a catch-up contribution of up to $7,500. Many employers match a percentage of employee contributions, essentially providing free money for employees' retirement savings. Employer contribution may be subject to a vesting schedule, which means that the employee must work for the company for a certain period before fully owning the contributions. Companies don't want to give you this money and then you leave the company immediately, so you typically have to earn it over a period of time. Investment options. 401k plans usually offer a range of investment options, including mutual funds, target date funds, and sometimes company stock. Loan provisions. Some 401k plans allow participants to borrow from their account, although this should generally be considered a last resort. Loans must be repaid with interest. Next, we look at some of the advantages of 401k plans. First, they grow tax deferred. 401k plan investments are deducted from income before taxes are paid. Potential employer matching is the second advantage, and 3, they have high contribution limits. Some disadvantages of 401k plans: 1, there are limited investment options; 2, potentially high fees; and 3, withdrawals are taxed as ordinary income. And there's a fourth one: early withdrawals before the age of 59 and a half may incur significant penalties. All right, as we continue, next we will look at 403b plans. 403b plans are similar to 401ks, but they are offered by public schools, non-profit organizations, and certain religious organizations. Some similarities and differences between 403b and 401k plans. 403b plans function similarly to 401ks in terms of contribution limits and tax treatment. However, they may have different investment options, including annuity contracts. They may also have different eligibility criteria. The contribution limits for 403b plans are the same as for 401k plans. And some special features of 403b plans: certain long-term employees can make additional catch-up contributions if they've worked for a qualifying organization for 15 years. Next up is 457b plans. 457b plans are typically offered by state and local governments and some non-profit organizations as well. The contribution limits are the same as for 401k and 403b plans. However, 457b plans may offer additional catch-up provisions. And some unique features of 457b plans: now, unlike 401k and 403b plans, they do not impose a 10% early withdrawal penalty for distribution made before age 59 and a half. And that's a big advantage of the 457b plan. You can withdraw at any time without penalty. Next type of employer-sponsored plan is the Thrift Savings Plan, or TSP for short. The TSP is a retirement savings plan for federal employees and members of the uniformed services. Structure and investment options. TSP offers both traditional and Roth options with a selection of index funds and life cycle funds. Contribution limits and matching. Contribution limits are the same as for 401k plans. The government provides matching contributions for most participants. Next, we look at pension plans, defined benefit plans, and how they work. Now, as I mentioned before, a pension plan is what is called a defined benefit plan. Defined benefit plans promise a specified monthly benefit at retirement, often based on salary and years of service. Calculation of benefits. These plans typically use a formula considering years of service and final average salary to determine the retirement payment. Pros and cons. Defined benefit plans provide guaranteed income but are becoming less common due to high costs for employers. The second type of pension plan is a cash balance plan. Cash balance plans are a type of defined benefit plan that resembles a defined contribution plan. Each participant has an account that grows annually, and benefits are expressed as an account balance rather than a monthly benefit. And that's going to be it for employer-sponsored plans. And now we'll take a look at retirement plans that individuals can create for themselves without going through their employers. These are called individual retirement accounts or IRAs. And we'll start with looking at a traditional IRA. Eligibility and contribution limits. Anyone with earned income can contribute to a traditional IRA. And for 2024, the annual contribution limit is $7,000 with an additional $1,000 catch-up contribution if you're 50 and older. Tax deductibility rules for traditional IRAs. Contribution may be tax deductible depending on your income and whether you're covered by an employer-sponsored retirement plan. Investment options. IRAs typically offer a wide range of investment options, including stocks, bonds, mutual funds, and ETFs. Distribution rules and penalties for IRAs. Withdrawals before age 55 and a half may incur a 10% early withdrawal penalty, in addition to regular income taxes. Required minimum distribution. Individuals must start taking required minimum distributions from an IRA at age 73 as of 2024. Therefore, when you reach 73, you must start taking this income from your IRA, or you would incur a penalty for not doing so. Next type of IRA is the Roth IRA. Eligibility and income limits for this investment account. Contributions to a Roth IRA are subject to income limits, and for 2024, those limits phase out between $146,000 and $161,000 for single filers, and $230,000 to $240,000 if you're married and filing jointly. Contribution limits for Roth IRAs are the same as for traditional IRAs. That is $7,000 annually with an additional $1,000 catch-up contribution if you're 50 and older. And tax treatment of contributions and withdrawals. Now for the Roth IRA, contributions are made with after-tax dollars, but withdrawals in retirement are tax-free. And that's a big advantage of the Roth IRA. Some individuals use what is called a backdoor Roth strategy to contribute to an IRA despite being over the income limits. Unlike traditional IRAs, Roth IRAs do not require minimum distributions during the owner's lifetime. And the reason for this is because you've already paid the tax on it. When you withdraw, there's no taxes involved, so therefore no penalty for not withdrawing. Next, we look at a SEP IRA, which is a simplified employee pension. They are designed for self-employed and small business owners. SEP IRAs allow employers to contribute to traditional IRAs set up for employees. And the contribution limits for 2024, contributions can be up to 25% of compensation or $69,000, whichever is less. And some of the advantages of SEP IRAs. SEP IRAs are easy to set up and maintain, and there are no filing requirements. Next, we look at a simple IRA. And simple IRA means savings incentive match plan for employees. They're suitable for small businesses. They're designed for businesses with 100 or fewer employees. Contribution limits for 2024. Employees can contribute up to $16,000 annually with a $3,500 catch-up contribution if you're 50 and older. Employers must either match employee contributions up to 3% of compensation or contribute 2% of each eligible employee's compensation. Differences from other IRAs. Simple IRAs have higher contribution limits than traditional IRAs, but lower than 401ks. I will now take a look at self-employed retirement plans. And we'll start with a solo 401k. Solo 401ks are for self-employed individuals with no full-time employees except for a spouse. High contribution limits. For 2024, up to $69,000 annually and $76,500 if you're age 50 or older. And this combines both employee and employer contributions. Loan provisions. Many solo 401k plans allow participants to borrow from their accounts. A Roth option is available. Some providers offer a Roth option for solo 401kbs. Next, we look at KEO plans. And there are two types, profit sharing and defined benefit. KEO plans can be set up as either profit sharing or defined benefit plans. Their contribution limits vary based on the type of plan, but can be higher than other self-employed options. Advantages for high-income self-employed individuals. They can allow for very high contributions, particularly for defined benefit KEO plans. Next, we look at Health Savings Account or HSA. And the eligibility requirements. You must be enrolled in a high deductible health plan and not enrolled in Medicare to take advantage of an HSA. HSAs have triple tax advantage. Contributions are tax deductible, they grow tax free, and withdrawals for qualified medical expenses are tax free. That's the trifecta of tax advantages for HSA accounts. Contribution limits for 2024, $4,150 for individuals and $8,300 for families, with an additional $1,000 catch-up contribution if you're 55 and older. Using HSA as a retirement savings vehicle. After age 65, HSA funds can be withdrawn for any purpose without penalty, though non-medical withdrawals are taxed as income. So it can be used as a regular retirement savings account if you don't need it for medical purposes alone. Here we have a table showing the different type of retirement accounts and certain features. We have account type, then we look at contribution limits, tax treatment, whether they are required minimum distributions, early withdrawal penalties, employer contributions, and special features. A traditional 401k, for example, has contribution limits of $22,500 for 2024. Contributions are made pre-tax. There are required minimum distributions, and the early withdrawal penalty is 10% before 59 and a half, before age 59 and a half. Employers are allowed to make contributions, and special features include employer match. A 457B has 22,500 contribution limits for 2024. Contributions are made pre-tax. There are no required minimum distributions, no early withdrawal penalties, no employer contributions, and no early penalty as a special feature. I will not go through all of these, but it's going to be here that you can come back to the video and look at it. And it goes all the way down to HSA, which has contribution limits of 3,800, which has contribution limit of $3,850 for 2024. Contributions are pre-tax, and there's no required minimum distributions, no penalties, and no employer contributions, but it has triple tax advantage, which we talked about earlier in the video. So this table is going to be here. You can come back to the video, take a look at it if you want, and learn all the different features of the different types of retirement accounts. And we leave it here for this table, and you can always refer back to it. Let's now take a look at some strategies for maximizing your retirement savings. First, diversifying across account types. You should consider using a mix of pre-tax and Roth accounts to provide tax flexibility in retirement. Prioritizing contributions based on individual circumstances. Generally, prioritize accounts in this order: 401k up to the employer match, then max out your IRA, then back to 401k, and then to taxable accounts. First, you start with your 401k up to the employer match. Then you max out your IRA, then back to the 401k, and then to taxable accounts. You should consider tax implications in retirement planning. Think about your current tax bracket versus your expected tax bracket in retirement when choosing between traditional and Roth options. If you think your tax bracket is going to be higher during retirement, then a Roth option makes sense, because then with the Roth, you don't pay any taxes when you make withdrawals. Some common mistakes to avoid in retirement planning. 1. Not taking advantage of employer matching. Always try to contribute enough to get the full employer match in your 401k. 2. Ignoring fees and expenses. Pay attention to expense ratios and administrative fees, as these can significantly impact your returns over time. 3. Failing to rebalance your portfolio. You should regularly review and rebalance your investments to maintain your desired asset allocation. 4. Understanding distribution rules. Be aware of required minimum distribution rules and early withdrawal penalties to avoid unnecessary taxes and fees. Understanding the various types of retirement accounts is important for effective retirement planning. Each account type has its own advantages and disadvantages, and the best choice depends on your individual circumstances, including your current financial situation, employment status, and future goals. Remember that retirement planning is not a one-time event, but an ongoing process. Not a sprint, but a marathon. As your life circumstances change, you may need to adjust your retirement savings strategy. It's often beneficial to consult with a financial advisor to help you navigate these decisions and create a personalized retirement savings plan. By taking advantage of the appropriate retirement accounts and consistently saving over time, you can work towards building a secure financial future for your retirement years. And that brings us to the end of today's video. It's that time again when I ask you to comment, like, and share this video and subscribe to the channel. And remember to let us know topics on accounting and finance that you would like to see covered in future videos. Thank you for watching and see you in the next video.